Welcome and thanks for tuning in today for our latest report. This is the ALTP, and today's report, Mandatory Car Insurance, Necessity or Oligopoly. Now, before we get started, I think it's worth giving a brief description of what an oligopoly even is. Some of you may have never even heard this term, or might not be familiar with its real meaning. By definition, an oligopoly is a market where a small number of sellers control pricing. They can manipulate supply to influence prices, often setting them close to the highest consumers are willing to pay. Now that we broke that down, here's some backstory to the auto insurance history. For nearly a century, operating a motor vehicle has been legally classified not as a right, but as a privilege, one that comes with a mandatory price tag. Beginning with Massachusetts in 1925, states realized that the rise of the automobile brought catastrophic financial risk. Mandatory liability insurance was born from a simple logic. If you cause harm to an innocent third party, you must have the financial means to make them whole. Today, the privilege is becoming a crisis. As of early 2026, average car insurance rates in some regions have surged by more than 50% since 2022. For many, auto insurance is now a secondary mortgage, a mandatory expense that must be paid before a citizen can even drive to work to earn the money to pay it. For clarity, the property and casualty insurance industry saw record profits, including an $88 billion net income in 2023. The primary defense for mandatory insurance is the protection of the innocent victim. Without it, an accident could lead to an unraveling of contracts, where victims cannot recover losses, leading to a cascade of medical debt and bankruptcy. Beyond just insurance, the law requires financial responsibility. If you're at fault in an accident, you are personally liable for damages that can easily reach hundreds of thousands of dollars. Mandatory minimums, like Texas's $30,000 for bodily injury, $60,000 per accident, and $25,000 property damage requirement, act as a baseline safety net to prevent a single mistake from destroying multiple lives financially. Proponents argue that we all benefit when the insured pool is maximized. It stabilizes the economic system by ensuring that healthcare providers and repair shops are paid, and it prevents the costs of uninsured drivers from being shifted onto the general public. Critics point to a fundamental extraction dynamic. The state mandates that a citizen must buy a product from a private, for-profit corporation. In many states, this has created a captive market where consumers have no exit strategy other than to stop driving, which, in most of the U.S., means losing their livelihood. Then if you do need to use it, the insurance company usually tries to find a way to deny your claim. In some cases, denying it based on facts they were already aware of while you were paying in the first place. Then if they do pay out, they penalize you for using the insurance that you're forced into paying hundreds of dollars a month to have. Is the industry an oligopoly? While there are hundreds of providers, the market is increasingly dominated by massive carriers with super-priority negotiating power. Consolidation among distributors and the use of advanced technology for risk sorting allow insurers to cherry-pick the most profitable, low-risk drivers, leaving high-risk or low-income drivers with unaffordable pricing based on zip codes and credit scores rather than just driving ability. When premiums rise beyond a household's breaking point, we see a rise in soft fraud and drivers dropping coverage entirely. As of 2026, 1 in 4 people have downgraded or dropped insurance to free up cash for other necessities. This ironically drives rates higher for the remaining compliant drivers, who must pay for uninsured motorist coverage to protect themselves from the very system that was supposed to protect everyone. For a low-income driver, poor credit can result in a premium 3 to 3.5 times higher than a driver with excellent credit, regardless of their driving record. This transforms the mandate into a poverty penalty. When a driver cannot afford the premium, they face a no-win scenario. drive uninsured and risk license suspension, fines of up to $350 or even jail time, or give up the car and lose the ability to go to work or take children to school. It's a lose-lose-lose-lose situation for you and an unchecked cash cow for the insurance company. You lose when you're forced to buy car insurance from someone who can set the price themselves, that you're required by law to pay. You lose when your credit score is low, because apparently your credit score drives the car. You lose when you're accused of doing something wrong in the car that you're paying to be covered. Police can simply say you were speeding or not wearing a seat belt, and with most people struggling to make it as it is, they don't have the time to take off work to defend themselves or hire an attorney to defend them, so they take a plea or pay more money for a driver safety course. Either way, you likely see rates increase, and you lose when you actually need to use it. One claim or even a roadside assistance claim will likely cause your rates to increase. The ALTP style critique here is clear. The state has effectively outsourced its safety regulation to private corporations that prioritize margin over the citizens' ability to function in society. Some economic audits suggest that less price regulation, not more, is the answer. In states with strict price caps, insurance firms often exit the market entirely, reducing competition and driving up the residual market of high-risk drivers. When states liberalize their markets, the forces of competition can theoretically drive out inefficiencies and lower costs. In the corporate world, large firms are increasingly self-insuring through captives to bypass traditional carriers. However, this exit strategy remains a luxury of the elite. For the average person, the only true deregulation would be a legislative shift that restores the right to prove financial responsibility through means other than a monthly check to a corporate management complex. The auto insurance mandate sits at the intersection of a genuine social necessity and a corporate extraction engine. While we require a mechanism to handle the financial externalities of high-speed accidents, we must ask, at what point does a mandatory safety measure become a predatory toll booth? If the cost of the mandate exceeds the citizen's ability to provide for their family, the system has failed its original purpose of protecting the public interest. True economic sovereignty requires a housing and transportation system where the individual is not a revenue farm for corporate entities, but a sovereign actor responsible for their own risks. That's it for this one. Thanks for walking through this topic with us. If you like this story and want to follow us for more, you can follow us on Facebook at the ALTP and X at the _ALTP with 2 E's. And on Instagram at the _ALTP. This has been brought to you by the American Liberty and Transparency Project. God's truth, our liberty, our republic. Until the next one, thanks.